Hello and welcome to a new series of trading videos featuring the smart money technique. Today, we will discuss how to enter trades and set stop losses in various market structures. The first structure relates to breaking previous highs and lows on a single time frame. The second structure involves analyzing higher time frames and entering trades on lower time frames. Finally, we will delve into trading within liquidity areas. If you found the video helpful, please like and subscribe to our channel. In a bullish trend, new higher highs are consistently formed. When these previous higher highs are broken by an order block, typically forming a break of structure, B.O.S, the price often retraces to the order blocks. This area is usually considered the optimal entry point for a trade. After the price reaches the order block area, you can enter a trade with a very tight stop loss, placing it just below the order block area. Typically, when the price reaches this area, it changes direction and continues its previous trend. However, there is always the possibility of a trade failing. Our recommendation when trading with the smart money technique is to hold on to trades until reaching a significant supply or demand area. However, this trading style is applicable only as long as the price movement does not encounter a significant supply and demand zone. In other words, if the price reaches a critical supply or demand area, we should no longer enter a trade when it reaches the order blocks. This is because there is always the possibility of the order block breaking, leading to a change in character. Let's become more familiar with the concept of a change of character. Whenever the price reaches a significant supply or demand area and after changing direction, breaks through an order block, it forms a change of character. This chart is for the 4-hour time frame. You can observe the complete breakthrough of an order block on a lower time frame. In such cases, the overall price trend usually changes, and it is advisable not to enter trades against the trend. Now, on this chart, we will discuss how to enter the trade. After the formation of a change of character, new order blocks and B.O.S's take shape. These order blocks can be considered as optimal areas for entering a trade. As you can see, 2 of the trades turned profitable, and 1 of them incurred a loss. As long as the price has not returned to a significant demand zone, you can hold your trade and consider this crucial demand zone as your take profit. Sometimes a change of character occurs in the form of a flip. This means that after a change in trend reaches an order block and returns to its original trend, the presence of significant volumes of buy or sell orders can lead to a complete change in the trend's formation. A flip can function similarly to an order block, and when the price reaches that area, it has the potential to induce a change in the trend. One important point that should always be kept in mind is that some of the space above the order block should also be considered part of the order block. Now, let's discuss placing sell limit and buy limit orders between 2 key supply and demand areas. In a bearish trend, you can place a sell limit order in the higher supply area. When the price reverses and reaches the order block, the supply zone typically triggers a decline in price, and this descent persists toward the demand area. Consequently, we may contemplate setting our take profit within the demand zone. However, if a change in the price trend is due to encountering a significant demand area, we should no longer place a sell limit order in the supply area. This is because there is always the possibility that the price may not react to the supply zone, and our order may fail. If the price surpasses the demand area and the area experiences a break, we can once again place a sell limit order upon the price retracement in the supply area, disregarding the previously braked demand zone. Now, let's discuss how to trade in different time frames. On higher time frames, such as the 1-hour chart, we identify 2 key supply and demand zones that indicate the formation of a change of character. Next, we switch to a lower time frame, namely the 15-minute chart. In a lower time frame, you can identify the order block that caused a trend reversal. Now, the strategy is to wait for the price to reach the order block area before entering a buy position. We enter a long position when the price reaches the order block area, and we set our take profit at the supply area. Then, we wait for a break of structure and trend. Allowing us to enter a buying position again when the price returns to the order block. We continue this process until the price reaches the main supply area. An important consideration is making the right risk-to-reward ratio choice. Therefore, always factor in a portion of the area below the order block and consider spreads in your stop-loss selection for your trades. Even with the failure of one of the trades, due to the high risk-to-reward ratio in this type of strategy, it can still be profitable for us. And finally, trading in the liquidity zone. Wherever you see equal highs and lows on the chart, it can be considered a liquidity zone. Due to the market's ranging nature in this zone, avoid entering a trade. Order blocks before these zones can be a suitable area to enter positions. You can watch the complete liquidity video inside the channel. If this video has been helpful for you, please like and subscribe to us.